Hi all, and thank you for joining us in our 2024 complimentary webinar series covering the FAR, or Federal Acquisition Regulations. We're coming to you live today from Washington, D.C., and thank you for being here. So just a little bit about the series. As usual, all of our webinars are complimentary and recorded, and the FAR has 52 total parts, so we're going to run through them sequentially each week on Wednesdays and Fridays at noon Eastern Time. And then the recordings and PowerPoints are going to be posted within 24 hours of the webinar ending. And you can find these recordings on our YouTube channel simply by subscribing to it using the link you see on the screen, and there's no cost for this. You can find the PowerPoint on the SlideShare site using your LinkedIn credentials to log in, and there's no cost for this either. We also offer sponsorship opportunities if you're interested in that. If you are, please send us an email to hello@jenniferschaus.com. And now how to sign up for the series. Unfortunately, there's no bulk registration, so you do have to register individually for each webinar. If you go to the Jennifer Schaus website and you navigate to the section called the FAR, you'll find the individual registration links, and the recording links will be posted here upon completion of each webinar as well. Please note that we covered the FAR in 2020, so if you're eager to get a jump start, you can find these historical recordings on our site. If you navigate to the webinars tab and scroll down to the section, the FAR 2020, but just because it has been 4 years, many of the regulations have changed and been updated, so please use this as a reference tool only. And just a little bit about us, we work with established federal contractors worldwide, helping them to navigate the market. Our services range from market analysis reports to contract vehicles and compliance. And some of the contract vehicles we support are listed here on your screen. So for more information on that, please visit our website. So those are our services for federal contractors, but we also provide marketing and advertising services for organizations who are selling to federal contractors. We can add extra muscle to your marketing efforts via our newsletter ads and webinar sponsorships and in-person events. So please email us and ask us for our media kit. We're currently offering a spring special with discounted rates, more specifically buy one, get one for our newsletter. Ads will run for 13 weeks starting May 6th. So if you have any questions on that, feel free to email us for questions or a quote. Contract vehicles can be a great marketing tool for pursuing federal businesses, and current open solicitations include Navy Seaport Next Generation and NASA SOUP, as well as GSA Alliant. Additionally, the GSA Multiple Award Schedule is open and rolling RFP. If you qualify for any of these and need proposal support, please email us for a quote at hello@jenniferschaus.com. And as you know, congressional hearings on both the House of Representatives and on the Senate side are open to the public unless otherwise stated, and we have a list here of upcoming schedules, including the date, time, and building and room numbers. Most meetings take place in the Dirksen, Rayburn, or Cannon buildings, so if you're selling to any of these departments or agencies, attending the hearings can be a great way to gather information, understand the process, and also network with influencers. Jennifer will be teaching in these upcoming webinars for the Michigan Apex Accelerator. Please join us for these educational webinars, and they're complimentary, and we hope to see you there. Registration can be found in our newsletter, or you can email us to get the link. Additionally, Jennifer will cover GSA schedules as well as federal marketing for our local Apex Accelerator in Virginia. These are complimentary and online webinars, so please join us for that. Coming up in June, we'll hear from Carrie Palmatier on small business innovations in federal contracting. Specifically, Carrie will cover information on SBIRs and STTRs. These two options are a great way for tech companies to grow in the federal sector, and this is a two-part series. And as always, these are recorded and complimentary. As always, our webinars are complimentary thanks to our long-time and in-kind generous corporate sponsors. Please allow me to introduce them. We would like to thank our friends at GovEvents, the premier platform for posting events related to government and government contracting. You can find all of our webinars and our events at govevents.com, as well as recordings from our past 600+ webinars. We also want to thank Tom Johnson and his team at Set Aside Alert, the go-to publication for contracting opportunities for small, women-owned, veteran-owned, HubZone, and 8A firms. Visit setasidealert.com for more information on that. The Fairfax Economic Development Authority has an online calendar of events and webinars, and we want to thank them for posting our events and webinars on their calendar. The Virginia Apex Accelerator at George Mason University offers free one-on-one counseling to established government contracting firms in Virginia on federal, state, and local procurement topics. So if you're interested in learning more, please use the links provided to explore their services, review homework recommendations, register for live trainings, and find useful links to their agencies and other self-directed learnings. One-on-one counseling is limited to eligible companies, and appointment requests are handled in the order they were received and based on counselor availability due to high demand. Online resources and group trainings are free with no restriction on business location. Join the Greater Reston Chamber of Commerce's monthly GovCon Council meetings, network with peers, learn about upcoming events and opportunities, and help to shape future programming. The meetings take place on the fourth Tuesday of each month at 8:30 a.m. at the Greater Reston Chamber of Commerce, and the next meeting is going to be on May 28th. The Greater Reston Chamber of Commerce will be hosting its 12th annual NOVA B2G Matchmaking Conference and Small Business Expo on May 2nd in Reston, Virginia. The event includes networking, matchmaking, breakout sessions, an expo hall, and keynotes from the government and industry. Attendees can schedule one-to-one matchmaking meetings with primes and general agencies and also visit the expo showcasing services to help GovCon succeed. Education sessions will cover the full life cycle of government contracting from proposal creation to compliance, so please visit novab2g.restonchamber.org for more information. Do you want help winning government contracts? BidSpeed can help. Users can find contract opportunities from federal, state, and local government. Additionally, you can search for teaming partners, incumbent point of contact, expiring contracts, compliance matrices, and also proposal templates. Create your login today at bidspeed.com. BidSpeed is an official partner of the U.S. Small Business Administration's E2G Empower to Grow program. Events are the ultimate channel to bring government and industry together, and 68% of government personnel report that they attend more than one event each year. The Federal Business Council, or FBC, has worked with government and industry for 45+ years to create gatherings where ideas are shared and to help government achieve its goals. This includes agency industry days, cybersecurity symposiums, technology expos, and off-site meetings. FBC provides full lifecycle meeting planning and event management. With over 5,000 meetings under their belt, FBC has the experience, systems, and personnel to make your next event exceptional. Learn more at www.fbcinc.com. Please also check out our friends over at GovBrew. GovBrew is the most read GovCon newsletter, keeping thousands of GovCon professionals in the loop with news, updates, and opportunities in the federal contracting market, all in a fun and accessible email that only takes 5 minutes to read. It's 100% free to join. It goes out every Monday, Wednesday, and Friday at 7 a.m., and it's filled with great content, event postings, webinars, and more. We encourage you to sign up at govbrew.co, or you can use the QR code you see on the screen. Today's webinar is sponsored in part by KAL Technology ID Consulting. KAL Technology helps businesses take their software to the next level. With over 20 years of experience working with federal contractors on large-scale systems from ship control to cloud, KAL Technology understands the challenge of constantly evolving technical environment while maintaining legacy capabilities. Please visit KAL Technology at www.cal.technology or call them at 844-930-2218 for more information. Okay, now let's meet today's speaker. Please welcome Timothy Laughlin to the webinar. We're honored to have you here with us today and are so excited to hear your presentation on the FAR. We appreciate the time you took to put together the content. Now, Timothy, I'll put myself on mute and turn the floor over to you. So please let me know when you're ready for your next slide, and I'll advance them as we discussed.
Sounds great. Thanks for the invite. I'm really pleased to present today on FAR Part 28. You know, it's not the sexiest of FAR parts out there, but it is nevertheless important. A little bit about myself. I'm an attorney here at Schoonover & Moriarty in Kansas City. As an aside, I'm very pleased with the Chiefs' first-round pick last night. I know most people aren't, but I very much am. But anyway, here at Schoonover & Moriarty, we represent small business federal government contractors who have, you know, a variety of needs. These include bid protests at the Government Accountability Office, the Court of Federal Claims. These include size and status protests before the Office of Hearings and Appeals, claims before the ASBCA, you get it. Drafting and preparing joint ventures, we do that. Teaming agreements, mentor-protege agreements. We also help our clients with compliance questions and issues related to size and status. This could be affiliation concerns or compliance with certifications like WOSB, SDVOSB, HubZone, stuff like that. So it's a real good split between litigation and transactional assistance. And so that's what we do here. Fun fact about me, before I was an attorney, I was actually a professional DJ for 9 years. So that's a little bit about me and the firm. We'll move on to the actual presentation though, if you want to move to the next slide. So today we're talking about FAR Part 28, bonds and insurance, and kind of what I alluded to earlier. You know, I've attended many presentations about the FAR, and more often than not, the speakers end up skipping over this part, and it's because it is, you know, sort of boring, and like I said, it's not that sexy, but it is important, right? You know, FAR Part 28 describes the requirements to obtain financial protection against losses in both sealed bids and negotiated contracts. Now, this includes, which we'll talk about, bid guarantees, bonds, alternative payment protections, security for bonds, and insurance. So ultimately, FAR Part 28 is how the government protects itself from loss when either, you know, using a sealed bid under FAR Part 14 or a negotiated procurement under FAR Part 15. Next slide, please. So bid guarantees. I just wanted to put out a little disclaimer. You know, I'm an attorney. My main job here is to interpret and apply the laws written. So I'm qualified to talk about FAR Part 28, and we deal with it here occasionally at SCUNMO, where our clients have questions about bonding. But we don't deal with bonds on a daily basis, right? I can't tell you how to go about getting bond capacity or things like that. Sometimes we deal with it in mentor-protege agreements where the mentor will provide bond capacity for their protege. But as far as like telling you how to get a bond, that's not what I'm here to talk to you about today. I'm here to talk to you about sort of the language of the FAR part. So with that being said, we're going to first start talking about bid guarantees. And a bid guarantee is a form of security that provides and requires that the bidder will not withdraw the bid during the period for acceptance and will execute the contract, will furnish any required bonds, including any co-insurance or reinsurance requirements within the time specified in the contract. Now, a bid guarantee is required when a bond is required. You know, that could be a performance bond, it could be a payment bond, but anytime any of these bonds are required, so too is a bid guarantee. Now, a bid guarantee can be waived by the government or the contracting officer if they determine that that is in their best interests. Specific examples of this involve usually contracts that are overseas, emergency contracts where, you know, they're just trying to get the work done. They don't have time to secure bonding, or in sole source contracts where maybe the government only received one bid, right? There's a certain process for this waiver that I won't get into, but that's sort of the idea behind a bid guarantee. Is it essentially ensures or is a guarantee that the bidder will not withdraw the bid during the performance for acceptance, and will provide a bond within the time specified. Next slide, please. So you may be wondering, okay, a bid guarantee is great. What amount does the bid guarantee have to have? Well, here it says the contracting officer is the one who will determine the amount of the bid guarantee. And essentially, it has to be adequate to protect the government from loss should the successful bidder fail to execute further contractual documents and bonds as required. Again, FAR Part 28 is really about protecting the government. I'll probably say that 100 times in this presentation, but that is the purpose here, is to protect the government's interests. Now, specifically here it says it must be at least 20% of the bid price, but no more than 3 million. So let's say you have a 40 million bid. 20% of that would be 8 million, but it couldn't be 8 million because the requirement requires no more than 3. Now, there are certain occasions where the bid may have to increase based on changes to the contract, but as an initial matter, these are sort of the two requirements here. Next slide, please. So now we're going to talk a little bit about non-compliance with bid guarantees. So for sealed bids, if you fail to provide a bid guarantee, it will be rejected. That's the long and short of it. It'll just be rejected. For negotiated bids under FAR Part 15, a failure requires rejection of the initial proposal as unacceptable, But there are some exceptions that are listed in the FAR part. And some of these include where only one offer is received. We talked about that just a minute ago. You know, if there's a sole source award, or on the occasion that there's like an emergency situation, that can be an exception. If the bid is late and the late receipt was waived, then that's another exception. A few others, if the bid, otherwise acceptable bid bond is undated or wrongly dated, or was signed in the right circumstances, or just simply failed to list the United States as the obligee, but is otherwise correct. Those are some exceptions. Like I said, there are other exceptions under the FAR Part 28, specifically 101-4. One of which doesn't come up often, but includes where the bid guarantee was submitted is less than required, but is equal to or greater than the difference between the offer price and the next higher acceptable offer. Now, we don't see this one too much because it's sort of risky to have a bid that is less than required. One, the agency might see that as too much of a risk. They might find you a non-responsible bidder, or they might see it as being too risky to give you the contract. But because this exception, which I didn't list here, but I'm talking about, because it relies on what other people bid, you don't know what other folks are going to offer. So, the long and short of it is, if you're going to put a bid guarantee, or if you're going to bid for certain contracts, you want your bid guarantee and the bond that is backed up by that bid guarantee to be of an amount that is required by the contracting officer. Next slide, please. So bonds. Really what a bond does is it makes sure the party who's seeking to contract with the government will do what it says it's going to do. A bond is a written instrument between the bidder and the surety that assures fulfillment of the obligations to the government. If the obligations are not met, the bond assures payment to the government. And there are several different types of bonds. We have advance payment bonds, which we'll talk about a little bit. Annual bid bonds. So in lieu of separate bonds to secure all bids, this is it secures bids during a fiscal year. Now, annual bid bonds and annual performance bonds do not apply to construction contracts. They apply to service contracts, but for construction contracts, contractors will not be able to utilize annual bid bonds or annual performance bonds. We also have patent infringement bonds. This secures fulfillment of the contractor's obligation or obligations under a patent provision. And then we've got the sort of meat and potatoes of bonds, which are payment bonds and performance bonds. And these secure payment to all persons supplying labor or material, so subcontractors. And for a performance bond, that ensures that the contractor will actually perform. So those are the different types of bonds here. Next slide, please. We talked a little bit about the difference between construction and non-construction. Here we're going to focus on performance and payment bonds for construction contracts. So performance and a payment bond under what was formerly known as the Miller Act required that construction projects exceeding 150,000 must provide performance and payments bonds. Again, this may be waived, particularly if most or much of the work is performed in a foreign country, and a bond there would just essentially be impracticable, or if it's authorized by another statute or law. So, I'm not aware of many construction contracts these days that don't exceed $150,000. So more likely than not, if you're going to bid on a construction contract, you're also going to be required to provide a performance and payment bond, unless, of course, it can be waived. Next slide, please. So we're going to stay in the construction square, if that's what we want to call it. But now we're going to focus on contracts that are in between 35,000 and 150,000. Under these circumstances, the contracting officer shall choose two of the listed bonds there, or following alternative payment protection methods. So unlike when the contract is over 150,000, then you must have a performance and payment bond. When it's between 35,000 and 150,000, you don't necessarily have to have both a performance and payment bond. It just must be two of the following. So it could be a payment bond. It could also be an irrevocable letter of credit, also known as an ILC. We also see tripartite escrow agreements. The definition of tripartite literally means to divide something into three parts. So essentially what this does is it creates a middleman between the contractor and the government. And what happens is the contractor will establish an escrow account with a federally insured bank or financial institution, and will enter into a tripartite escrow agreement with that bank who acts as the escrow agency. And all of the suppliers of labor and material, the escrow agreement will establish terms of payment under the contract and resolution of disputes among the parties. And when the government makes payments to the contractor's escrow account, the escrow agent or bank will distribute the payments in accordance with the agreement, or if there's a dispute, the bank will trigger the disputes resolution procedures if required. So this is a little bit more involved. It involves a middleman, the bank, to sort of act as that middleman. That's sort of what the tripartite escrow agreement is. Certificates of deposit, they're more simple. The contractor deposits certificates from a federally insured bank to the CO, and that's executable by the CO or contracting officer. And then, of course, the last one, security deposit. We all know what a security deposit is, but essentially, these alternative payment protections must be provided before the contractor will be provided its notice to proceed with the work from the agency. And of course, it's up to the contracting officer to choose which of the two they will implement. Next slide, please. Okay, performance and payment bonds. So we're still in construction, and really the question is, how much must a bond be for? Again, this is all about protecting the government's interests, and of course, it's sort of at the discretion of the CO. So for contracts exceeding $150,000, the performance bond, that requires the performance bond and a payments bond. The performance bond must be 100% of the contract price plus any increase unless the contracting officer determines a lesser amount is adequate. Similar for the payment bond, must be 100% of the contract price plus any increases unless the CO makes a written determination that the amount is impracticable, but it must be no less than the performance bond. So you can't have a payment bond that is less than your performance bond. For contracts that are greater than 35,000 but less than 150,000, the payment bond and alternative payment protection, whichever one that they choose, or whichever two that they choose, 100% of the contract price plus any increases unless the contracting officer determines that a lesser amount is adequate. So sort of the same idea between the two. The difference is, of course, with a $150,000 construction project, you're going to need the performance bond and the payment bond, but for in between that and 35K, the contracting officer gets to choose which alternative payment protection it wants to implement. So that's sort of the distinction there. Next slide, please. So now we're going to move on to non-construction bonds. So fun, I know. We're chugging along. We're doing this together. But generally, bonds, performance and payments bonds are generally not required, but they are permitted. If they're not originally in the contract and the government wants them to be, they'll have to modify the contract to require a performance or payment bond. Like I said, the performance bond may be required for contracts greater than the simplified acquisition threshold if necessary. And again, to protect the government's interests. That's what this is about, protecting the government's interests. So examples of this where the government might have an interest is where the government property or funds are utilized by the contractor. Instances of novation where the government wants assurances that the successor is financially capable. So for those of you that don't know, a novation is essentially when a prime contractor either sells their entire business to another entity or sells assets used to perform the contract to another entity. And so in this instance, the government will recognize the successor in interest to the federal contract, that they essentially purchase the prime contract and are the new prime contractor. And what will happen is the contracting officer will strike the name of the original prime and replace it with the new performer. And so in the event that the government might believe or have concerns that the new performer might not have the financial capability to perform the contract, then they may require that a performance bond be put in place just to cover the government's interests. So that's a little bit about novation. The instance of substantial progress payments being made before delivery. So this is essentially when the government is required to pay the contractor before delivery of the end product. They might also want a performance bond when the contract is for dismantling or demo. Now this one's kind of funny to me because dismantling or demolition seems like a construction type activity, but for whatever reason, this example is under the non-construction side of things. So just wanted to point that out. The big takeaway though is, you know, at this last point, a payment bond is only required when a performance bond is required, and the use of a payment bond is also in the government's interest. So you can't have a payment bond without a performance bond. So if you're in a situation where you're bidding on a non-construction project and the government wants you to provide a payment bond but not a performance bond, they can't do that. You must have a performance bond in place in order to require, or you must require a performance bond before you can also require a payment bond. Next slide, please. Here are some other types of bonds. We talked through the list before, but again, we've got annual performance bonds. How much should these bonds be? Well, it's based on the gross penal sum equal to the total amount of all covered contracts. Ultimately, it's up to the contractor to determine how much bonding it needs for an entire fiscal year. Remember, these annual performance bonds are for the fiscal year only. So it is up to the contractor to determine how much bonding it needs. Now, if the contractor underestimates, an additional bond will be required to cover the additional contracts. And again, these do not apply to construction contracts, only for non-construction. We've got advance payment bonds. These are for contracts with an advance payment provision, but no performance bond. Doesn't come up a lot, but they're really there to protect the government where they have to make those payments before that end item or product is produced. And then we did mention patent infringement bonds. Again, these secure fulfillment of the contractor's obligation under the patent provision, and really only come into play if a performance bond is not furnished and the financial responsibility of the contractor is unknown or in doubt. Next slide, please. So we've sort of moved from bid guarantees to bonds, and now we're going to sort of shift our focus to sureties. And you know, a surety is an entity or person who a creditor, i.e. the government, can come to claim payment for or from the contractor. Consent of the surety, when the contract is modified, a contractor must get the consent of a surety. If an additional bond is obtained from a different surety, no additional bond is required and the modification is beyond the scope of the original contract or changes the price by more than 25% or 50K, or in the event of a novation, which we talked about earlier. Next slide, please. There are three options for securing bonds through sureties. Most sureties will be this first sort of prong of approved corporate sureties, but they don't have to be. They can also be individual sureties who pledge assets, or it could be a person, the contractor, pledging assets directly. Oftentimes, contractors do not have, or individual people do not have the capacity to fully insure a project like this. We'll talk about that in a little bit, but that's why it is designated as a rare type of security for a bond. Next slide. A little bit about corporate sureties. So the Treasury keeps a list of approved corporate sureties. These sureties are identified in the Department of Treasury's Circular 570. And essentially, these are just companies that are sort of pre-approved by the government to provide bonds. The penal amount can't be more than the surety's underwriting limit unless, of course, it is co-insured or reinsured, or where the coinsurance or reassurance does not exceed the entity's underwriting limit. Next slide. Individual sureties. These are where individual sureties must pledge acceptable collateral. The Treasury has a list of what this collateral could be. Essentially, it is the net adjusted value of collateral must exceed the penal amount of the bond. So oftentimes these individual sureties are smaller and have smaller underwriting capacities than corporate sureties. And so to adjust to that reality, a contractor can submit up to 3 individual sureties per bond. And the Treasury will assess the eligibility of each of those sureties and can later request a substitution of an asset or a surety. Essentially, what the CO must do is ensure that the pledged assets are sufficient to cover the obligation, right? If the CO rejects a surety, that rejection is a finding of non-responsibility. Meaning that the contractor is not able to be awarded the contract or the solicitation. There are exceptions to this, but only if the government finds that it's in its best interest to sort of waive this non-responsibility finding. If found non-responsible, the FAR does state that this finding need not be referred to the SBA for a certificate of competency. Essentially what that is whether or not the surety or contractor, through an extension of its surety, is a responsible bidder. And even though the FAR says that it need not be referred to the SBA, that doesn't necessarily mean that a finding of non-responsibility could not be referred to the SBA. Essentially, if you were in this situation, you may suggest to the CO that it be referred to the SBA to determine whether you as the contractor is competent or not, because it's a big deal if you're not. That means you can't receive the award. So if this happens to you and you really like your surety, then perhaps request that the contracting officer refer the matter to SBA for a certificate of competency determination. They don't have to, but if you have a good working relationship, you're the incumbent or something like that, and you really like your surety, then it might be worth requesting that the CO refer it to the SBA. If you don't care about your surety, then of course just find another one. But if you do care about your surety and that's what's holding you up, it doesn't hurt to ask. Next slide, please. So exclusion of individual sureties. We talked about this happening. We didn't talk about the causes or why it happened. So the exclusion of individual sureties list is posted on SAM. Causes for exclusions include failure to fulfill obligations of a bond, failure to disclose bond obligations, misrepresentation of the value of assets or liabilities, false or misleading statements, any other cause of serious or compelling nature. So pretty much your typical reasons why you would be put on a blacklist. Essentially, you're either inadequately documenting or listing the obligations of a bond, or you were, misrepresenting either intentionally or unintentionally value of all your assets. The bad things that you always hear about people going to jail for. I'm not necessarily saying that these sureties went to jail, but that's just a reason why they are excluded and put on a list. Next slide, please. Contractor assets. So, like I mentioned, this is a rare occasion, but any person can put up an acceptable security in the form of bonds or notes, certified cashier's checks, bank drafts, money orders, cash, ILCs. It can happen and it can work. The question the government is going to have is, are we adequately protected by using the contractor as their own surety? And usually, businesses don't have the liquidity to protect themselves and really protect the government here and their interests. So oftentimes you see contractors asking for or seeking individual sureties or corporate sureties that are listed on the Treasury's Circular 570. So that's contractor assets. Let's move on over. I think the next slide is insurance. Yeah, so we've talked about bid guarantees, bonds, sureties, and now, believe it or not, we're almost at the end of the FAR Part 28. Woohoo! So we're going to talk about insurance. This part of the FAR Part 28 mostly covers when insurance is required and how much insurance is necessary. So insurance is required when the contractor is subject to Cost Accounting Standard 416. This is accounting for insurance costs. It's also required when the contractor is required by law to provide insurance. So an example of this is workers' compensation. When the commingling of property, type of operation, circumstances of ownership, or condition of the contract make it necessary for the protection of the government. Again, there we are, protecting the government always. Insurance is required there. Or when the award is for healthcare services, you must maintain medical liability insurance. Now, under that first, I guess it'd be the second bullet, when the contractor is subject to Cost Accounting Standard 416, the contractor is not required to have insurance, even when they are subject to Cost Accounting Standards 416 under limited circumstances. And that's when the government agrees to indemnify the contractor under specific circumstances, or when the contract specifically relieves the contractor of liability for loss of or damage to government property. So there is an exception to that second bullet, but all the other ones do not have exceptions. Moving forward, next slide. So when we think about insurance, we're always thinking about risk, right? The risk of bodily injury, the risk of, a myriad of risks, right? And so when it comes to the type of contract, risk, the shifting of risk really plays a different role depending on what type of contract you're entering into with the government. So for fixed price contracts, a fixed price contract is where the government agrees to pay a certain amount and not 1 cent more, right? And so because of this, the government is not really concerned about insurance because all the risk is on the contractor. So the government is normally hands off when the contract is a fixed price. Compare that to a cost reimbursable contract where, reasonable costs will flow up to the government. The government could be liable if something happens as a result of any project or contract. So for a cost reimbursable contract, the government is going to want to have certain insurance policies in place, and we'll talk a little bit about that on the next slide, I think. But here for fixed price contracts, government's hands off, may require insurance when the contractor is engaged in government work, government property is involved, the work is on the government installation, or where the government assumes risks that would normally be covered by commercial insurance. And this all makes sense, right? The government wants to insure and protect its own property interests. And so that makes sense here for fixed price contracts. Next slide, please. Here's liability coverage, and this really comes into play with those cost reimbursable contracts. Liability coverage here, we're talking about workers' compensation. FAR requires at least $100,000 for that. It requires general liability coverage for bodily injury, at least $500,000 per occurrence. And for property damage, it's only required in special circumstances. If your job or the contract requires driving of any sort, there'll be automobile liability coverage. There you can see it's at least $200,000 per person and $500,000 per occurrence for bodily injury, and $20,000 per occurrence for property damage. On the limited occasion where you're required to fly a plane or operate a watercraft or vessel, you can see the requirements there. For aircraft, coverage, this isn't on the slide, but coverage for passenger liability for bodily injury shall be at least $200,000, and that is multiplied by the number of seats or passengers, whichever is greater. So that's not on the slide, but that's just a little tidbit for you if you're working on a contract involving aircraft. Next slide, please. Self-insurance. So what is self-insurance? Essentially, to qualify for a self-insurance program, the contractor must demonstrate its ability to sustain the potential losses involved. So in other words, they need to be able to demonstrate that by setting aside their own money, it will be able to pay for possible losses. Now, this requires a written proposal and the contracting officer's approval. Normally you go through an insurance company, but this is sort of a one-off where the contractor's saying, no, I can cover it. It'll be fine. You need to put together a plan in this scenario, and the contracting officer needs to approve it. The contractor, like I said, must demonstrate the ability to sustain the potential loss involved, and the factors that the contracting officer will consider in its approval or denial include the soundness of the contractor's financial condition. That's probably the biggest one, right? You need to be able to pay for this if it happens. The geographic dispersion of assets, this is sort of like diversification of assets. The history of previous losses. Do you have a history of, crashing your car or flying your airplane into a building, right? If you do, it's probably not going to work out for you. The type and magnitude of risk, and compliance with federal and state laws and regulations. So, those are some of the factors that the CO will ultimately look at to determine whether or not they will approve or deny self-insurance from a contractor. Next slide, please. We made it. Cool. So that's FAR Part 28. If you have one key takeaway, it's just about protecting the government. They want to make sure that you will perform and pay the necessary bonds. And while this part is not, as I'll use the word sexy again, it is important. So I really thank Jennifer Schaus for letting me talk about FAR Part 28. If you'd like to contact me about this part or any of the specifics, there's my email there. You can also connect with me on LinkedIn. I'd be happy to connect with you there. But I guess thank you again, and until next time.
Thank you, Timothy, for a very informative presentation, and thanks for everybody who joined us today as well. As mentioned, you can always catch the recording on our YouTube channel within 24 hours and find over 600 webinars on government contracting there. And that's it for today's webinar. Thank you again, Timothy, and thank you for all of you who joined us today, and have a wonderful Friday and a wonderful weekend.
Thank you.